The number of Americans filing for jobless benefits unexpectedly spikes to 10-month high. Now, that is actually a good sign if you want interest rates to lower. So hang tight before you are sitting there worried about this. Hang tight for a second. So here we go. The number of Americans filing for unemployment and benefits increased by 13,000 to 242,000 the week ending June 8th, the highest level in 10 months, surpassing the pre-pandemic average of 218 and indicating a potential cooling of the labor market due to high interest rates. Contributing claims, those filed by Americans consecutively receiving unemployment benefits, rose by 30,000 to 1.82 million for the week ending June 1st. Bill Adams, chief economist for Comerica Bank, stated that while jobless claims are volatile, this increase might signal a sustained higher unemployment rate. Despite the surge, the labor market remains historically tight, with the economy adding 272,000 jobs in May and the unemployment rate ticking up to 4%. Tom?
Well, first of all, the big number to look at is now we have 1.82 million people sustained unemployed that are actually being counted as receiving benefits. That's a big number. And now, pre-pandemic, okay, this is the fall. This is Q4 2019. Before the spring of 2020, we all know the basketball game, everything happened, and it was, off and running with COVID and the pandemic, was 218,000. Now we're up to 242. So after all this up and down of the COVID and everything that's gone on, now we have more new unemployment benefits being filed each week and the highest level in 10 months. Now, why is this good for interest rates? It's bad for these people and these poor families. But what it means is that when unemployment goes up, now there's extra people available for jobs. And that means it's less that usually wage growth usually stalls a little bit. And wage growth is tied to inflation because wages go up. Business employs a bunch of people with wages going up. They raise the price of the product. There's inflation, wage, product, and the cycle. Well, now this is showing that it's cooling a little bit, which also could lead to maybe the Fed making 2 cuts between now and the end of the year. September and December is what a couple major banks think will be, so that you could be at 6.75 for mortgages by the end of the year. Right now, it's still a tick over 7. So this is a sign that all the raising of interest rates by the Fed and other things, are settling, even though it is hard for the consumers that are being impacted.
Let me continue with the stories that were here with economy. Fed's Kashkari says it's reasonable to predict December rate cuts. And then Barron says why the Fed is unlikely to cut interest rates before December. Now, some are saying it's going to happen by September. Some are saying it's not going to be happening. Let me read both of these stories. Let me read one of these stories to you. Federal Reserve Chairman Powell made it clear that a rate cut before December is unlikely, emphasizing the bar to cut the federal funds rate from its current 5.25 to 5.5 target remains high. He stated that it would take a convincing slowdown in inflation or a sudden spike in the unemployment rate for any change, adding neither seemed likely this summer. Despite May's lower than expected inflation data, Powell noted the persistence of high shelter prices, which have risen 0.4% for 4 straight months and 5.4% from earlier this year. Powell reiterated the Fed stance. If the economy remains solid and inflation persists, we're prepared to remain the target range for federal funds rate as long as appropriate. Powell also noted the Fed's latest projection, just 1/4 percentage point interest rate reduction in 2024, down from 3 cuts in March. Damn. Tom?
Well, this is what we were just talking about. So the Fed is saying, hey, I'm really not sure about September. And remember, Kashkari, remember that word, Kashkari. Well, Kashkari goes out. He is the Jean-Pierre for Powell. And so he comes out and he makes these speeches, and he's with the Minneapolis Federal Reserve President, Neil Kashkari. So he goes out and makes statements, floats them out there. But it's when Powell speaks is actual policy and the actual position statement. So basically what they're saying is, unless we get a spike in unemployment, whoops, what just happened yesterday? We just saw that. Jobless claims up. And so that's leading the banks to say, I hear you, Fed. I hear what you're saying. Don't expect it in September, maybe 1/4 point cut in December. But we think the jobs data and everything else is going to cause you to cut twice. The basically end thing is From the beginning of the year, we speculated about 4 cuts. We speculated about 3 cuts. It's all coming home here, and it looks like there is going to be the beginning of the cuts, whether it's September or December. But we are now on the eve in the second half of this year getting the cuts, which will give a little bit relief to mortgage rates, a little bit of relief to auto loans, and that's where we're going.
Adam.
Well, don't look now, but we're basically 4.5 months before Election Day 2024. So what I think is everything that's going on in the economy is sort of baked in the cake. Biden isn't going to do anything to change the economy in his favor, nor is he going to do anything to try to dismantle what they've already done. Jerome Powell's already come out there and basically said, listen, we're kind of keeping it as is. If this happens in December, that's after the election. So I think where the inflation is right now, I think where unemployment is right now, I think where the Fed fund rate is right now, it is what it is. And if Trump gets elected, I think Jerome Powell's seen his final days. Obviously, Janet Yellen will no longer be Treasury Secretary. Trump's floated names like Arthur Laffer, if you're familiar with the Laffer curve, or the Kevin guys, Kevin Hassett and Kevin Warsh. But I think it is what it is. I think we are where we are. And I think what we're going to do is we're going to wait and see what happens on Election Day to see what happens with the economy.
Until then, we still have a major affordability crisis of the cumulative impact. All these things we're talking about are the signs that we're about, I think, to tick a little bit different. But the affordability for the average American is still horrifying.
Tom, FYI, this is not good for Biden, because what Americans will forgive you on is, say if he were to lower the rates, and I'm talking Powell, say if he were to lower the rates and you see sudden, slow movements, the 3 rate cuts, this would have been very big for Biden if we would have had the 3 rate cuts. The fact that Powell is saying it's not going to happen until December, this benefits a couple different things. One, I think it benefits a healthier economy, because for people to, and I would be happy without lowering rates at all in 2024, and we wait till Q2 of next year. Let's just kind of let it roll the way we're going to cool everything off. But politically, kind of helps one guy, and he's got a house in the city called the Beaches of the Palm. There's a lot of
Mar-a-Lago.
Mar-a-Lago. Not Mara-Saba, it's Mar-a-Lago. Mar-a-Lago, different than Mara-Saba.
It's a different thing right there,
It's a different Mara. Yeah, but It is what it is that he's got that going on. Here's what we're doing at the Comedy Club, 5990 Live. We and our staff will be watching the debate, and we'll do a podcast that night. The debate is at 9 o'clock, 9 to 10:30. So we're talking about 9 p.m. Eastern Standard Time. We will probably start at 8:30 and go till about 11:30 and comment on it. And there's going to be an audience there of our teammates, and family and friends will be there as well. However, for the first 50 people that purchase $300 worth of merch, we will give you 2 tickets to come and attend the event with us.
Sick.
And people that purchase the $300 worth of merch, priority for seats will be based on first come, first serve.
So if you like this clip and you want to watch another one, click right here. And if you want to watch the entire podcast, click right here.